Hey everyone. As we enter June and summer vacation season, I thought I'd take a look at what's happening with hospitality and hotel real estate. Now, the hotel sector will likely be affected by the economic headwinds I discussed last week. Oil remains in the $100 per barrel range and gas prices are running around $4.30 per gallon. And that's pushing inflation toward 4%. In addition, the rising cost of jet fuel has pushed air travel costs up by about 21% compared to last year. The employment market remains soft and consumer sentiment is at a record low. Together, these economic forces will likely affect people's vacation plans for the summer. According to a recent survey by Bank of America, 70% of respondents indicated that elevated gas prices are causing them to adjust their summer travel plans. And a study by Deloitte pegs the percentage of people planning to stay in paid lodging this summer at 45%, the lowest reading since 2021. So while the economic trends and these surveys paint a challenging picture for the hospitality industry, when you dig under the surface, the impact is much more nuanced. Again, based on the Deloitte survey, there has been a broad-based pullback in summer travel plans. But for households with incomes above $100,000, the reduction is relatively modest, down 4 percentage points. However, for those with incomes below $100,000, the impact is more substantial, down 8 percentage points year over year. So the impact on the hospitality sector is relatively concentrated in the limited service hotel segment. Now, the limited service hotel occupancy rate has been trending lower for several years. The occupancy rate of that segment peaked in 2019 a bit above 58%. Then, following the pandemic in 2021 and 2022, the occupancy was in the mid 57% range. But since then, occupancy has trended lower, most recently to the low 54% range. And when we measure the total number of room nights per year, the downward trend in demand for limited service hotels becomes readily apparent. But on the flip side, demand for select service hotels has remained relatively stable since 2022, while full service hotel demand has been rising. In net, the total number of hotel room nights sold has remained relatively stable since 2023. As of May 2026, the number of rooms occupied is down just 1% compared to the peak set in 2019. Looking deeper into the trend and breaking the performance metrics by chain scale, economy hotels demonstrate the most substantial performance softening in the post-pandemic era. Mid-scale hotels have also experienced some easing of occupancy rates over that time. At the same time, luxury, upper upscale, and upscale hotels have demonstrated the most durability in recent years. So, despite economic headwinds, the outlook for aggregate hotel demand remains durable and supply risks remain modest. New supply additions in the last 12 months are down by 34% compared to the same time frame in 2019. This construction slowdown reflects the elevated cost of construction financing, materials, and labor. And although the 2026 summer vacation season probably won't be a blockbuster year, it should prove to be steady with modest gains in the upper echelon full service segments. From an investment perspective, transaction velocity over the last 12 months through the first quarter has been accelerating. Property sales are up about 19% from the cyclical trough in 2024 and about on par with the transaction velocity of 2016. Pricing has remained relatively stable since 2023 at an average of $113,000 per key and a cap rate of about 8.7%. So for investors, the hospitality outlook remains cautiously positive but steady. Delinquency rates have been modest, well below the peak levels set in 2010 after the global financial crisis and during the pandemic in 2020. And like we've seen in other consumption markets like retail sales, there's an emerging bifurcation in the market, with upper tier hotels outperforming the low-cost segment. Looking forward into a cycle of potentially elevated inflation, hotels hold increased appeal as rates are set on a daily basis, generating greater inflation resistance. That said, over the longer term, looking past short-term headwinds, demand drivers could strengthen when the economy gains momentum. At the same time, new supply risk remains modest. That will reinforce long-term hospitality performance. And as always, investors have to focus on the long term as they keep their eyes on the horizon.